Ferrari has today a market cap that is 50% larger than Volkswagen, despite only selling around 14,000 cars in 2024, while Volkswagen sold around 9 million cars. How is this possible? Welcome to Investing Edge with Eric. In today's video, we'll analyze the iconic Italian car brand Ferrari to see if the stock is a buy despite having one of the highest PE ratios among European large cap stocks. I've gathered 5 years of financial data and modeled Ferrari's next 10 years of financial performance to answer, is Ferrari one of the best stocks to buy even with a PE ratio of over 50? As always, we'll go through 4 key sections, ending with an estimated annual return, a fair share price of the stock, and a final rating of the whole investment. So yeah, let's dive in and start with a brief intro to Ferrari as a company. Okay, so jumping into Ferrari's own website now. As many of you already know, Ferrari is a legendary Italian luxury automaker, known for its high-performance sports cars, cutting-edge technology, and of course, rich heritage. Founded in 1939, Ferrari builds some of the most exclusive and desirable cars. The company generates revenue primarily through car sales with ultra-high margins, driven by limited production and very strong brand loyalty. To be honest, the first time I actually analyzed Ferrari stock, I was shocked looking at the margins. Is this actually a car maker, or is this a technology firm or a software company? That's how good these margins actually are. Additional income streams, of course, include customization services of their cars. It includes licensing deals, merchandise, and sponsorships, especially in Formula One. So in essence, you could say that Ferrari's ability to maintain exclusivity while expanding its luxury brand presence makes it one of the most profitable automakers around the world, but it also opens up the company towards a few unique risks, which we will talk about more later on in this video. And just to quickly showcase one of my points, here are the fiscal 2024 year's highlights from Ferrari. And here you can see, for instance, that the shipments have grown 0.7%, while the net revenues are growing at 12%, while the EBIT is growing at 17%. So this shows, okay, Ferrari has strong pricing power. It can generate really high profit growth despite not really growing their shipments that much. Another slide that quite well summarizes Ferrari as a company is their shipments summary slide. Here we can see that Europe and Middle East is the biggest portion of their shipments, followed by the US, which of course is a risk looking at the recent Trump tariffs, which we will discuss of course later on. Mainland China is a quite small portion of their total shipments, which is quite unusual for luxury brands. Another interesting take on this slide is that we can see that Ferrari does not have any electrical cars as of yet. Currently, they have roughly 50% hybrids and 50% traditional internal combustion engine cars, so they haven't really introduced any electrical cars as of yet. With that said, now we have a sense of what makes Ferrari money. Let's move on to the next part of this video, which is looking at historical financial data from the company and see, okay, how is it that they have actually performed? Before jumping into our model, I just want to go through the analysis structure. So we're looking to generate an estimated annual return and also a fair share price of the stock. And to do that, we'll need 2 price targets for the IRR, a enterprise value price target and a free cash flow to equity price target. And for the fair share price, we'll do just a discounted cash flow analysis as well. Right, so I jumped into our model here and we'll focus firstly on the enterprise value data and go through some of the key metrics one by one and see how Ferrari has performed. So starting off with the revenue here, we can see we have data for all metrics going back all the way to 2020 to 2024. And we can see that the revenue has grown quite strongly each year. Every year it has expanded, and on average it has grown at 16% per year, which is incredibly strong for a car brand. At the same time, the EBITDA has grown at 21% per year, right? Steadily each year. And this suggests that the company is of course expanding its profit margins at the same time. If we look at debt, it has grown at only 1% per year. That's a good sign for us as investors because the debt is remaining quite flat at the same time as the company is growing rapidly. A similar story is reflected at the excess cash part of the company. We can see it has remained quite flat, and of course that makes sense. Why should the company start to hoard a lot of cash that it doesn't need? Why not keep it flat at a good level regardless of revenues growing at the same time? We can see that the market cap has grown at 16% per year. That's in line with the revenue growth, so that's a good sign. And we can see the enterprise value has grown also in line with that growth, right, at 16-15% per year. Now the enterprise value is of course the market cap plus the debt minus the excess cash. So with that said, here we have a few ratios. We have the enterprise value to EBITDA. We can see on average it's around 27.4 times per year. And the EBITDA margin is a whopping 36%. That's huge, right? I mean, that's beating most technology companies actually. That's incredible good margin for this company. And we can see the debt to EBITDA is around 1 times, right? It's 1.5 at the max, and then it goes down to 0.7 currently. That's a good sign for us as investors. We're targeting below 3 times, right? So that's a very good sign for us as investors. So incredibly good numbers so far. Let's continue here and look at the free cash flow to equity data table as well before we generate our 2 price targets. So starting with the operating cash flow, we can see it has grown 21% per year. That's in line with the EBITDA growth, and that's a good sign for us as investors. It suggests that the free cash flow is quite predictable within the company. At the same time, the capex has just grown at 7% per year, also indicating that the company is becoming even more profitable with time. We can see net debt payments being roughly minus 1% per year, and the shares outstanding declining 1% per year on average, showing us that the company is buying back stocks, it's not diluting shareholders, it's generating a lot of shareholder value at the same time. Now, this is also reflected if we look at the average share price per year. It's risen 17% per year, which is of course quite high, and the free cash flow to equity has risen at 18% per year, which is great numbers for us as investors. We can also see that the free cash flow to equity yield has been roughly 1.6% on average per year. It's remained quite steady over the years, of course, that's a good sign. And the free cash flow to equity margin has been roughly 16% historically on average per year. Now I've looked at the historical financial data of Ferrari. Let's do our first price target, which is the enterprise value price target in our model. And what we're doing here in essence is that we're applying a growth rate to the revenue 10 years going forward, where we'll get an ending EBITDA numbers in 2034. Now the growth rate for 2025 is in line with Ferrari's guidance, which is 5% growth for 2025. Then I'm saying 6, 7, 9, 10% before declining again to 9, 8, and 7%. This on average is 8% per year growth rate, which is of course much lower than the 16% that Ferrari has performed historically. The reason why we are applying much lower growth rate is because of recent uncertainties. We have trade tariffs with the US, we have China slowing down their economy, so having a CAGR of revenue growth of 8%, which is half the historical one, I think is quite conservative. It's what we should expect as investors going forward. So using these growth rates, we get an EBITDA in 2034 of roughly $6 billion. We apply an EBITDA margin of roughly 14%, which is slightly higher than their current margin, assuming that they continue to increase their margins long term. We're also applying a long-term multiple of 20 times, which is much lower than the roughly 27 times where they're at today, reflecting the lower growth rates. And that gives us an enterprise value in 2034 of roughly $122 billion. Having this enterprise value target in 2034, we reduce debt and we add back cash, which is the inverted enterprise value formula, which gives us a market cap of roughly $120 billion. If we assume the same growth rate of the shares being declining 1% per year on average, we can see that we get a price target of roughly $744 per share in 2034. Now with that said, we have our first price target. Let's calculate our next price target, which is the free cash flow to equity price target. Now applying these growth rates to the free cash flow per share, we can see that we'll land at $22 in 2034 per share. Applying a long-term free cash flow yield of 2%, which is higher than the 1.6% that they have, and a year zero free cash flow per share of $9.9, which is in line with the recent report, we can see that we get a price target of $1,098 per share. As we have two price targets, we're using both of them, we're weighing them equally, and we get a weighted price target of $921 in 2034. Now, as we have both of these price targets, let's do a stock valuation of Ferrari stock. Let's see what is the fair share price that we can look at today as investors. So we're back in the model yet again, and if I scroll down here, we can see that we have a fair share price of roughly $501 per share. And that's if we discount the future cash flows to a present value of today. Now, as we have this fair share price for Ferrari stock, we can compare it to the discount versus premium of the current share price. And here we can see that we have a discount of 21%, which in my opinion is quite strong considering the quality of Ferrari as a company. We saw how consistently they grow their revenues, their EBITDA, and they're becoming more profitable at the same time. Now, with that said, if we have this fair share price and we get this string of free cash flow per share distributed to us as investors, of course we have to buy the stock and we have to sell the stock, we get a cash-on-cash return of roughly 2.6 times all the way to 2034. And that is an IRR of 12% per year. That's the annual compounded annual return we as investors can expect from Ferrari stock. Now, 12% isn't huge, but at least it's beating the market. I'm assuming that the market will grow at roughly 9% per year. That's the S&P 500. So 12% is definitely above. Another interesting piece of information, I think, is that if we look at the table here to the very bottom, we can see what happens to the expected annual return if the stock goes down, which is green, or if the stock goes up, which is red, which is bad for us as investors. We can see if the stock goes down all the way, to $290 per share or 250 roughly, then we get an expected annual return of 18 to 20%, which of course is much more attractive than the current 12% that we can see today. So now we're given the stock evaluation. Let's also give it a final rating and see, is this an investment that we want to buy today, or is it something that we perhaps should stay away from? So I've given Ferrari stock a final rating of 4.5 stars. Let's go through the key criteria and see why it has scored so high. So starting off with the revenue growth, yes, the company is growing strongly at 16% per year. We can also see that the EBITDA growth is growing even higher than that. So that's 5 out of 5 for both of them. It also has strong free cash flow to equity growth, and it has low debt to EBITDA of below 3 times, which is a really good sign for us as investors. We can also see that the stock is performing quite consistently. It's growing quite nicely, and it's given returns that are above market for investors. Now, with that said, we can see that the company also has a high RRR versus the expected market return. We saw 12%. That's not crazy 20-30% per year to expect, but it's definitely higher than the market, so it's given 4 out of 5 stars on that one. It's also well priced versus its fair share price. At least it's undervalued, right? It's not crazy undervalued, but it's definitely undervalued. Now, looking at the final key criteria, we can see strong competitive positioning. Yes, I would say that's 5 out of 5. There are other car brands like Lamborghini or Porsche, right? But there are no other car brands that are growing at this rate, at this scale, with these margins. A reason why this is the case, of course, has to do with the strong brand and reputation of Ferrari. You could argue that Ferrari is the most iconic car brand that has ever existed. I sure do. Of course, this is subjective, but in my rating system, they've gotten 5 out of 5. Now, where Ferrari hasn't scored that well, it has to do with low legal and macro risks. This has to do with both the tariffs coming out from the US recently, who knows if they're still in place when this video drops, and also it has to do with China slowing down as well. These two are big headwinds for Ferrari. With the tariffs, if the cars become 20-25% more expensive, yes, Ferrari has pricing power, but that's still a big headwind for new customers buying their cars. So, to conclude, I would say that Ferrari is undervalued, but I wouldn't say that it's the most undervalued company I've ever seen. But perhaps we should listen to Warren Buffett here. It might be better to buy Ferrari, a wonderful company at a fair share price, than an average company at a wonderful price. Now, the big uncertainty for Ferrari investors right now, of course, has to do with the tariffs coming out of the US. But if you, just like me, expect that these tariffs won't be in place for that long, then Ferrari could be an amazing investment opportunity for the long term. So, thank you so much for watching this video. In the link below, I've linked the complete one-page I've used for this analysis. There you'll get 5 years of financial data, the full DCF assumptions, and the forecast summary as well. So yeah, please like and subscribe, and I'll see you in the next one.